ICAI sum number 4, May 2022. The particulars relating to Raj Limited for the year ended 31st March 2022 are given as follows. Output units at normal capacity, selling price per unit, variable cost per unit and fixed cost. The capital structure of the company as on 31st March 2022 is as follows. So there's this capital structure. There is equity share capital, reserves and surplus and current liabilities. Raj Limited has decided to undertake an expansion of the project to use the market potential that will involve 20 lakhs rupees. So additional requirement is 20 lakhs rupees. The company expects an increase in output by 50%. Fixed cost will increase by rupees 5 lakhs and variable cost per unit will decrease by 15%. The additional output can be sold at existing selling price without any adverse impact on the market. The following alternative schemes for financing the proposed expansion program are planned. So there are three alternatives, alternative 1, 2 and 3. Current market price per share is rupees 200 so that we can decide how many number of shares we can issue. Slab wise interest rate funds borrowed is as under, so 10, 15 and 20% is. Find out which of the above mentioned alternative would you recommend for Raj Limited with reference to EPS assuming a corporate tax rate of 40%. Please understand how we will solve this question. Number one, after expansion, what will be EBIT? This is our first criteria. Once we get EBIT, understand whether it is alternative 1, 2 or 3. It does not matter because EBIT, whatever is the capital structure will remain same for the company. So our first task is to find out EBIT. Then we will do that capital structure decision in our Excel sheet, option 1, option 2 and option 3. Wherever there is highest EPS, we will write that particular answer. So our first target, let us go, has decided to undertake an expansion project involving rupees 20 lakhs. The company expects an increase in output by 50%. So what is current output? 1 lakh. Now the capacity has increased and output will become 1,50,000. Selling price per unit is 40. And this can be sold at this rate. Even additional output of 50,000 can be sold at this rate. So we will be getting answer of sales. We can even find out variable cost per unit and then directly find out contribution. What is variable cost per unit? Currently, it is 20 rupees. But after expansion, because of economies of scales, variable cost per unit will decrease by 15%. So it will be 20 minus 15%. Will be 17 rupees. What will be contribution per unit? Will be 23 rupees. What will be total contribution? This multiplied by this. 1,50,000 multiplied by 23. 34,50,000. Minus fixed cost. What is current fixed cost? 10 lakhs. Which will increase by more 5 lakhs. Total will be 15 lakhs. This will be 19 lakh 50,000 rupees. This is nothing but my operating profit or EBIT. Please understand whether I go for option 1, whether I go for option 2 or whether I go for option 3. My EBIT is going to remain 19,50,000. Let me go to my Excel sheet, put in EBIT of 19,50,000 in all the cases. So in option number 1, option number 2 and option number 3, in all three options, it is 19 lakh 50,000. This should be option 2. This should be option 3. I've got my EBIT. Let me put in some of the basic details like tax rate. Tax rate is 40%. Total capital previously was 20 lakhs. Additionally, we are raising 20 lakhs more. So total will be 40 lakhs. In all three options, total capital employed is going to remain 40 lakhs. Alright, let us go to alternative 1, 2 and 3. How much debt will be involved? How much will be the interest? Alternative 1, 5 lakh debt and balance in equity. Alternative 1, 5 lakhs in debt. So my interest will be 5 lakh multiplied by, what is fund limit? 5 lakh. What is the rate applicable? 10%. 50,000 rupees. How much equity will be issued? Total fund requirement is 20 lakhs. If 5 lakh is issued by debt, remaining 15 lakhs will be issued by equity. Total will be 20 lakhs. How much number of equity shares will be issued? They are saying us that our current market price is 200 and whatever debt proportion you use, your market price is going to remain 200. So if your market price is 200 and you want equity of 15 lakhs rupees, 15 lakhs rupees divided by 200 will be number of new equity shares issued. $7,500 shares. Let me find out for all three alternatives. Alternative number 2. How much will be debt? 10 lakhs debt, balance equity. 10 lakhs debt. What will be interest on debt? They say up to 5 lakhs it is 10%. Over 5 lakhs and up to 10 lakhs it is 15%. So we will take it slab wise. How slab wise? Please understand. We are borrowing total 10 lakhs rupees, but on first 5 lakhs I will apply 10%. On remaining 5 lakhs I will apply second slab. And which is the second slab? Is 15%. So this is 50,000. This is 75,000. This is 1,25,000 will be nothing but interest. How much equity will be issued? 10 lakhs. Total capital employed will be 20 lakhs. New capital employed will be 20 lakhs. How much new equity shares will be issued? 10 lakhs divided by 200. Which is 5,000. This is alternative 2. Let us go to alternative 3. How much debt will be issued in alternative 3? 14 lakhs. More risky option. So equity will be 6 lakhs. Total will be 20 lakhs. Number of equity shares new will be 6 lakhs divided by 200. will be 3000 new shares. How much will be the interest? On first 5 lakhs, 10%. On remaining second 5 lakhs, 15%. On remaining 4 lakhs, it is like calculation of income tax. Remaining 4 lakhs, 20%. This is 50,000, 75,000, 80,000. That is 2,05,000. 2,05,000 will be interest. Let me put in all the data. We have found out additional number of equity shares in all 3 options, but we have not found out current number of equity shares. Current number of equity shares are 1 lakh. It is already given. So we'll be easily getting total number of equity shares. Let me fit the things over here. EBIT 19,50,000. Interest in option number 1 is 50,000. Taxes and everything I have kept it in formula. So it will be EBIT minus interest, EBT minus taxes. Taxes will be automatically calculated at 40%. Earning after tax is 11,40,000. Number of shares. How many new number of shares will be issued? 7,500. How many existing is there? 1 lakh. So total will be 1,07,500. Automatically I will be getting EPS. How I get EPS is earnings available to equity shareholders divided by number of shares. It is 10.60. Here, what is interest in option number 2? Interest in option number 2 is 1,25,000. Taxes, they take it automatically at the rate of 40% of EBT. I have got earning after tax or earnings available to equity shareholders. How many will be total number of shares? Will be 1,05,000. How? 5,000 new shares, 1 lakh original shares. So 1,05,000 will be nothing but new shares. What is my EPS? 10.42. Let me go to last option. What is my interest? 2,05,000. I will be getting EBT minus tax. It is 40% of EBT. Earning after tax, I am getting number of shares. Number of shares will be 1,03,000. And what I'll be getting as EPS is 10.16. So what is the EPS in option number 1? 10.60. What is EPS in option number 2? 10.42. What is EPS in option number 3? 10.16. We need to take a decision based upon EPS. If we want to take based upon EPS, option number 1 is most preferable because the EPS is highest at 10.60. So option number 1 will be selected. I'm writing it over here. Option 1 will be selected at, because it is having highest EPS. Sir, trading on equity will not work over here. Please understand it is difficult because of this. Still we can use it. Try to concentrate. How much is the total capital employed? Is 40 lakhs. How much is EBIT? 19,50,000. Let me make it this as 40 lakhs. ROCE in this case is 40%. But understand, equity is running at a premium of 190 rupees. Say that. What is the face value of equity? 10 each. And at what rate it is issued? 200. So by issuing one equity share instead of 10 rupees, 200 rupees will be borrowed. This will significantly reduce the number of shares which are increasing. If you increase more of equity and hence more of equity issue is promoted. Whenever there is a premium involved, the rate of interest is in slab. It is difficult to directly apply the concept of trading on equity.